Hey, it's Ron Yarbrough here at Prime Lending. I wanted to put out a quick video to let all those first-time home buyers and move-up home buyers that used a government home loan in the last 18 to 24 months. Most all government home loans have a Streamline refinance option, which is an incredibly easy way to improve your financial situation with a new loan. It's called a Streamline, and we'll go through a few of the details uh, right now. Anyway, so there's a three main government home loans are the Federal Housing Administration (FHA) non-credit qualifying Streamline, a credit qualifying Streamline, a USDA Streamline, and a Veterans Administration Streamline refinance program. The FHA programs are non-credit qualifying. You don't require an appraisal. We don't have credit requirements, except some companies, all have a minimum credit score. Must meet a net tangible benefit, which I'll explain more about that here in a little bit. Individuals can be added to the mortgage without a credit worthiness review, which is a bonus to a lot of people that bought a home and didn't get their spouse on the loan because of whatever reason. You can add them onto the loan on a Streamline to get them to benefit from the good credit history on a mortgage. Verify the funds needed if there's any needed funds to close. And we can sometimes get escrow advances to be approved to help with the amount of cash to close on those programs. Must be employed, but the income is not verified. Must be current on your mortgage for the last 6 months. No 30-day lates in the last 6 months. Mortgage must be in place at least 210 days prior to your previous loan, whether it be a refinance or a purchase loan, which is approximately 7 payments. Credit qualifying has the same options above, except we do review the income and employment and assets. And for that reason, if we're wanting to remove somebody from a loan or something like that, we have to do a credit qualifying Streamline refinance. USDA is called a Streamline Assist. There's no appraisal needed. You can include the principal, interest, and closing cost into your new loan. You can't have any defaults in the last 12 months. You can add borrowers, but you can only remove deceased borrowers. So there's no caveat to remove a borrower from the loan, like there is with FHA, unless they have been deceased. Verify assets if needed. No debt ratio calculation is required, and you have to meet a net tangible benefit. The VA interest rate reduction loan, in our industry, we call that a VA IRRRL. Interest rate must be at least 0.5% lower than your current interest rate. You must meet a 36-month net tangible benefit, which means you must recoup your closing cost or any cost incurred with the loan in less than 36 months in order to be eligible. No appraisal is required. You must be current on the mortgage. Mortgage must be at least 210 days old, which means after you purchased approximately 7 payments, or after your last refinance, at least 7 payments. There's no cash back allowed to the veteran, and there's no income or asset verification required. Net tangible benefit on FHA, you must lower your rate by at least 0.5%. On USDA, you must lower your payments by at least $50 or more. On VA, you must recoup the cost in 36 months or less. You take your old payment amount minus the new payment amount, divided by the closing costs. So if your closing costs are, say, $1,500, then you must save at least $42 a month in payment in order to qualify for the VA IRRRL. So this is just a really quick run over. If you'd like to get more specific information regarding your specific scenario, I'd love to help you out. We can do that without running any kind of credit or anything. We can analyze your entire situation and build a plan to help you save some more money as you continue to grow that largest asset that'll be in your portfolio, which is your real estate and your home. Hope that all helps you, and I'd love to help you out. Just give me a ring. Thanks. Bye.